Right now, you are looking at a falling silver price on your screen. Maybe it's $83, maybe $78, maybe lower. And somewhere in your mind, a voice is whispering, should I panic? Should I sell? Did I miss it? Stop, because that voice, the one reacting to the number on your screen, is the most expensive voice you will ever listen to. Silver fell to $83.70 per ounce on Tuesday, March 3, 2026, down another 7% on the day, after losing nearly 5% on Monday, wiping out the entire safe haven premium built on the back of the U.S.-Israel strikes on Iran. From its peak above $96, silver shed roughly 13% in just 48 hours. And here is what almost nobody is saying out loud. This is not the story of a metal that is broken. This is the story of a market that has two realities. And most investors are only watching one of them. The falling price you see on your screen is the paper market talking. The physical market, the vaults, the refineries, the industrial supply chains, the solar farms and AI data centers, is telling a completely different story. Today, we are going to follow the second story, because that is the one that determines where your wealth ends up. Before you can act intelligently, you need to understand precisely why silver is falling. Because the reason matters enormously. Silver's extraordinary rally earlier in 2026 was driven partly by safe haven demand, but also by speculative capital rotating from crypto and momentum traders chasing a parabolic move. That same hot money exits fast and without mercy. Here is the timeline in plain English. Silver surged 65% in January 2026 alone, following a 150% gain in 2025, creating massive profit-taking pressure. Gold hit a record high of $5,600 per ounce. Silver touched $120 per ounce. The numbers were extraordinary, the rally was real. And then, the trap was sprung. The CME Group moved to a percentage-based margin system in January 2026, hiking maintenance margins to 15% for standard positions and up to 16.5% for heightened risk, effectively ending the era of cheap paper speculation that allowed traders to control 5,000-ounce contracts with minimal collateral. Silver didn't just drop, it imploded. In a single session, the price collapsed by more than $47, triggering a wave of forced liquidations across retail investors, wholesale networks, and ETFs. Friday, January 31st, 2026 will go down in precious metals history. Silver crashed as low as $78.29, settling with a 31% loss, the steepest single-day decline since March 1980's Hunt Brothers silver collapse. The carnage erased approximately $15 trillion from gold and silver markets. Now here is the critical question, the one that separates informed investors from reactive ones. Did the industrial demand for silver disappear on January 31st? Did the solar farms cancel their orders? Did the AI data centers stop needing silver for their components? The real cause was margin exposure, not monetary policy. This was not a routine sell-off. It marked a structural failure fueled by reckless leverage. Silver traded more like a speculative tech stock than a historic store of value. The paper price crashed. The physical reality did not move an inch. I need you to lean in and really absorb this next number, 356 to 1. For every single ounce of physical silver that can actually be delivered, there are 356 paper contracts making promises against it. Think about what this means for you personally. Ask yourself directly, if you were a bank holding 1 ounce of silver but had issued 356 promises to pay it out, what would you do the moment clients all came knocking at the same time? You already know the answer. You would stall, you would raise barriers, you would make the process as painful as possible. And that is exactly what happens when delivery pressure hits the COMEX. As the selling intensified, liquidity dried up, premiums collapsed, and the entire chain, from coin shops to refineries, locked up. Dealers pushed exaggerated narratives about shortages while bidding $10 to $15 under spot for silver rounds. The paper price tells you what leverage speculators are doing with their margin accounts. It does not tell you what is happening to the physical metal that builds solar panels, powers electric vehicles, and runs AI server farms. Those are two completely different conversations. And right now, almost everyone is watching the wrong one. While the paper market was imploding, the physical world was issuing a very different report. The Silver Institute forecasts a 67 million ounce deficit in 2026, the sixth consecutive annual market deficit. Let that land. 6 straight years where the world consumed more silver than it produced. 6 straight years of drawing down the reserves that took decades to accumulate. For 2025, the market faced a deficit of 63.4 million ounces. While that figure is expected to narrow to 30.5 million ounces in 2026, the deficit remains a structural reality. This is not a temporary glitch. It is the outcome of a market where supply simply cannot respond fast enough. And why can supply not respond? Because about 75% of silver is mined as a byproduct of other metals such as gold, copper, lead, and zinc. Higher silver prices are not enough motivation for miners to increase production, because production decisions depend on copper, zinc, and lead economics, not the silver price alone. Even with silver at never-seen-before prices, it could be years before any sort of balance returns to the market. On the demand side, the numbers are relentless. Solar photovoltaic technology is among the most significant and fastest-growing applications of silver demand. In 2014, only 11% of silver industrial demand came from this sector, compared to 29% in 2024. The solar sector alone is projected to consume 240 million ounces in 2026. The automotive sector is equally critical. Electric vehicles consume roughly 67% to 79% more silver than traditional internal combustion vehicles. In the realm of AI and data centers, silver is becoming a bottleneck material. AI servers rely on high-speed, multi-layer circuit boards with silver-plated connectors to maintain low contact resistance. Silver-sintered thermal interface materials now regularly exceed 50 to 100 watts per meter Kelvin in thermal conductivity, far outpacing legacy materials to cool high-power GPUs. The AI revolution, the green energy transition, the electric vehicle build-out, every single one of these megatrends runs on silver, and none of them paused because a COMEX margin hike forced speculators to sell paper contracts. This is the most important concept in this entire video. Write it down if you have to. The silver market has split into two worlds. World 1, paper silver. This is what you see on your phone when you check the price. It is driven by margin accounts, algorithmic trading, momentum speculators, and leveraged futures contracts. When fear hits or margins get raised, this world collapses violently and without warning. On the way up, silver outperforms dramatically. On the way down, the exits are narrower and the drops are steeper. This is the world of 356 paper promises per physical ounce. World 2. Physical silver. This is the metal that sits in vaults. The bars that solar panel manufacturers need, the components that go inside every EV rolling off the assembly line, the connectors inside the AI servers processing information right now. This world does not care about margin hikes. It does not respond to fear. It responds only to supply and demand. And right now, demand structurally exceeds supply for the 6th straight year. Solar and EV manufacturers who stepped back when silver hit $120 have reportedly returned as aggressive buyers in the $80 range. Read that again. The industrial buyers, the ones who actually need the metal to build things, use the paper crash as a buying opportunity. Who is panicking? Leveraged speculators in paper markets? Who is buying? The companies building the infrastructure of the next decade. Which group do you want to be aligned with? The institutions are not on financial television panicking about the price drop. They are quietly repositioning. ANZ Bank upgraded its gold forecast to $5,800 per ounce for Q2 2026, citing central bank buying and structural support. And ANZ analysts emphasized that the rally is not yet mature enough to reverse. JP Morgan projects silver could average $81 per ounce in 2026. More than double its 5-year average. India became the world's largest importer of refined silver, with imports estimated at approximately $9.2 billion, marking roughly a 44% increase over 2024 despite sharply higher prices. When a nation is importing 44% more of something at sharply higher prices, that is not speculation. That is necessity. When real yields are low or negative, silver and gold attract significantly more capital as stores of value. Multiple interest rate cuts are anticipated through 2026, creating historically bullish monetary policy conditions for precious metals. And perhaps most telling of all, Wall Street analysts who had predicted the silver crash flipped from bearish to bullish immediately after the January 30th collapse. The people who called the crash correctly turned around immediately and called the next move up. Most investors think of silver as a hedge, a fear trade, something you buy when the world feels scary. That framing is outdated, and it fundamentally undersells what you are actually holding when you own physical silver in 2026. When you hold physical silver today, you are holding a triple identity asset. And understanding all three identities is what separates the investors who will look back on this moment with pride from those who will look back with regret. Identity 1. Industrial. Silver's critical role in solar, EVs, and AI infrastructure led the U.S. government to include silver on its critical minerals list. A manufacturer cannot simply remove silver from an EV's high-voltage system without compromising safety. An AI data center cannot operate efficiently without silver-enhanced thermal management. You are not holding a speculation. You are holding the material that makes the modern world function. Identity 2. Monetary. In a world where almost every financial activity incorporates credit risk, that of a state, a central bank, an intermediary, silver remains one of the only assets without counterparty risk. It makes no promises, pays no interest, and is not dependent on political decisions. It simply exists. Silver has outlasted every fiat currency in human history. Every single one. Identity 3. Strategic. China's decision to tighten silver export controls from January 1, 2026 marks a significant shift in global commodity strategy, effectively elevating silver from a widely traded industrial metal to a strategic resource, mirroring what Beijing did with rare earths a decade earlier. Governments are now competing for this metal. You are not buying a commodity. You are positioning in a geopolitical asset. This is not a fear trade. This is a conviction trade. You are not buying silver because you are scared. You are buying it because you understand what it is and what the next decade requires. Here is the truth that the falling price is trying to hide from you. Silver's 2026 performance reflects a market in transition, from one driven by news and sentiment to one increasingly shaped by fundamentals. As industrial demand continues to outpace supply and geopolitical risks persist, silver is positioned to remain one of the most consequential assets of this decade. The paper market is in chaos. The physical fundamentals have never been stronger. And the gap between those two realities, the bifurcation, is your opportunity. Despite the brutal correction, silver still shows gains of 163% year-over-year as of early March 2026. Even after the historic crash, even after the 31% single-day collapse, silver is still up 163% from a year ago. The investors who will regret this moment are those who looked at a falling number on a screen and forgot to ask, why is it falling? And does that reason change the long-term reality? The answer is no. CME margin hikes forced leveraged speculators out of paper contracts. That does not change the sixth consecutive supply deficit. It does not change the solar panels being installed today. It does not change the EVs rolling off production lines. It does not change the AI servers consuming silver-enhanced components at a rate no previous generation of technology ever demanded. The screen shows you the paper market. The vault shows you the truth. So here is what you do now. Not out of fear, but out of understanding. You separate paper from physical in your mind. You recognize that the price drop is a margin-driven liquidation event, not a change in the structural story. You understand that industrial buyers returned aggressively at $80. You position in physical metal. not paper promises, because despite the chaos, the underlying macro fundamentals for silver remain intact. This was a reset, not a reversal. The institutions are not panicking. They are converting paper promises into physical reality. They are securing delivery while the crowd is still staring at a falling number on a screen. The question is not, where is the price going? The price will find its own level. The question is, what do you actually own when the screen goes dark? Own the reality, not the promise. Stay informed, stay positioned, stay ahead.